Colin Cattell with Palisade Radio. We're delighted to have serial entrepreneur, financier, and CEO of Golani Gold, Ravi Sood, as our guest this week. Ravi grew up in Canada but now resides in Hong Kong. He's founded and financed many big successes in the financial and business world, such as Buchanan Renewables, Feronia Inc, and Golani Gold. Ravi is known in Canada as a regular TV personality and is frequent guest host of the Business News Network's evening program Squeeze Play. He's best known for commenting in the media on the income trust sector, global markets, natural resources, and agriculture. Ravi, thanks for joining us.
Colin, it's a pleasure.
You've been involved in the management and ownership side of many large corporations in many different sectors in the past. Why have you chosen at this time to stick with the natural resource sector as your current focus, and in particular a junior mining company?
Well, Colin, as a money manager, I worked and managed through two of the most chaotic time periods in at least the modern history of capital markets, that being the bursting of the tech bubble on September 11th, and of course the 2008 global financial crisis. And as painful as those time periods were, coming out of them were two of the greatest opportunities for capital appreciation and making investors money in the history of capital markets. And where we are now, not such a horrific situation in capital markets generally, but for junior resource stocks, yeah, we're in a nuclear winter and we're just coming out of it. So there is that kind of scale of opportunity for the right kind of company and the right kind of opportunity. So it is probably the single most interesting sector to be involved in right now, and that's what we're doing with certainly with some of my investments, and in particular Golani Gold.
On that point, many prominent analysts in our sector and many of the most successful investors in the space say that we're in the early stages of a new bull market for natural resources and that the bottom in the market is behind us. Are we in the early stages of this bull market? Is it already going? And what do you see in the years ahead for the natural resource sector?
I think it will be a year plus into the bull market before we all realize that we are in fact in a bull market. I think it'll be slower and more measured and more rational than the last big bull market in resources. We saw a lot of excessive activity, a lot of quick rotation into what were frankly very small segments of the minerals industry, different types of specialty metals. Interesting opportunities in and of themselves, but not really broad themes to chase after. This time, investors are going to be more measured, more disciplined. And it will be as a result more selective. So it'll be less apparent that we're in a bull market. But yes, I think that's where we are. We're starting to see the thawing. We're starting to see financings getting done, and we're starting to see mergers and acquisitions activity. So we had a long period of depressed share prices and a lot of people seeing value in the market, but very little activity. Very few larger or medium-sized companies were pulling the trigger. Now, not only are we seeing companies active in the sector deploying their money and using their shares to make acquisitions at big premiums as well, we're even seeing private money and private equity funds set up using cash to privatize mining companies. And that you really only see when you're at the very extreme end of the value curve. And that's what's been happening for about the last year. So as I said, I think it's going to be more measured. It'll be slower this time, more selective, but it's already started, and we're headed in that direction.
You use the word selective, and I think that's a great lead into Golani Gold. You're the CEO, a junior gold mining company, which is producing around 50,000 ounces of gold per year. You have an $11 million market cap and around $11 million in cash in the bank. I just can't find anything else that's this undervalued. With companies like yours relatively beaten down in terms of share price the last couple of years, what kind of gains could the junior mining equities reap for early investors if we look at what some of these companies like Golani Gold might be worth 3 to 5 years from now?
Well, I'm just going to go back to that earlier comment, Colin, about being selective. I described the sector as going through a nuclear winter, and there are any number of stocks that are down 50, 75, or even 95% from their peak. However, even with the sector turning, investors are going to be more selective. The financing and the availability of capital that was there in the 2002, 2003 to 2007-8 time period it's just not going to come back at the same pace, and it's just going to be far more disciplined. So, what kind of names, what kind of companies are going to come back and produce those capital gains for investors? It's those that are not as dependent on markets for funding to develop their business. So, those that are able to generate their own cash flow and have leverage already to the underlying commodity prices. So, producers is what I'm getting at there. Amongst the producers, where do you have the most leverage and the most opportunity? The smaller ones. So, in general, you'd prefer a more diversified producer, perhaps a lower cost producer, multi-mine, multi-jurisdiction. But those companies, their shares have held up a little bit better, which has been good for investors. They're still down. There's still an opportunity there for sure. But the ones where we've seen a really extreme devaluation and by the same token have really exceptional upside opportunities now are the smaller producers and the ones that have maybe other limitations that made them less desirable in recent years, being single asset, single jurisdiction. They're just so depressed that the opportunity there is absolutely massive. I'll give you one example. A company I'm on the board of, Elgin Mining, excellent company, about a 45,000 ounce a year gold producer operating in Sweden. We recently agreed to sell the company to Mandalay Resources, a great company, taking back Mandalay shares at what amounted to 75 or 80% premium. And I would say, with no hyperbole, the buyer got a great deal. And both the buyer's shares and our shares went up after that. And I think it was a great deal for all parties. And that was with a huge premium. And they're still getting it at a discounted valuation. So that kind of opportunity is there in the short term through mergers and acquisitions activity. And there's much more upside than that for those who can hang on and play out the cycle. I think 75 or 80% upside will look very small compared to what players who don't need to tap the market for equity, who can fund their growth and have leverage to the underlying commodity price as we come out of this nuclear winter.
Can you give our listeners an overview of Golani Gold? What's in store moving forward this year?
Well, the key thing about Golani is we have consistently been a producer of about 50,000 ounces a year. We took over the operation. It was a subsidiary of Gold. We took over in 2011, and it was an undermanaged operation inside Gold. Gold's a great company. They've got a fantastic set of assets. But this was the smallest one inside their portfolio, and it really it didn't get the attention it deserved. And since transitioning to Golani management, we've managed to get costs down substantially. And so that's an ongoing effort for us. I think we're hitting the point where we've maximized what we can do on that front. We can always do better and do a little bit more, but we've taken most of the low-hanging fruit. So our opportunities now are more on the growth side. So we're looking to expand in terms of expanding our resource, extending our reserve life, and taking what we have, which is a stable operating platform and a profitable one in a low-risk jurisdiction, and using that to capitalize on other opportunities in the sector. So we're not going to be very aggressive. We're going to be very careful because what we have organically is very good. But we are looking to grow from our very stable and profitable platform. We have, as it is, huge leverage to the underlying commodity price. So if you look at our past results in 2012, for example, in one quarter, our operation produced $9 million of free cash flow. That was in a quarter where we averaged about $1,665 an ounce on our gold sales. We're obviously not there right now. It's about $350 higher than where the commodity is right now, but that's the kind of opportunity for us and the kind of leverage that we have to the commodity price. If you start to see gold moving higher, our shares have so much leverage to that. We have so much potential to generate cash flow immediately based off our existing operation. It's just a huge opportunity for investors who can get in at this level.
And Ravi, more on leverage. Golani Gold qualifies perfectly as what Eric Sprott defines and has been investing in, which is marginal gold producers. Your current cost per ounce is a bit below, around $1,000 an ounce, a bit below where the current gold price is. And what many investors don't realize is that for the upside of the share price, having an asset producing close to the current gold price gives you a lot more leverage as the commodity price moves up. Can you touch on that just a bit more?
Well, that's exactly right, Colin. So if you're a $500 an ounce producer and the gold price moves up $100 from 1,300 to 1,400, it's obviously a positive, but it's a small move on where you're already at. But for us, that's huge leverage. So we're financially stable at $1,300 gold, at $1,200 gold, even at $1,100 gold. But as you get up and above that level, as you get to $1,400 and above, we have tremendous operating leverage. So at 50,000 ounces a year, every $100 is roughly $5 million of additional free cash flow. And remember, our market cap is about $10 million. Our enterprise value is close to zero. So every $100 of additional gold price at 5 times earnings or 5 times cash flow is 5 times our share price for each $100. So that's the kind of leverage we're talking about. $200 an ounce higher on gold at 5 times multiple, that's 10 times our market cap.
Ravi, on that note, thanks so much for your time today and thanks for joining us.
My pleasure, Colin.